On this edition of Chart This, we'll be looking at the Fed announcement last week, the correlation between gold and silver, and more coming up. Gary, thank you very much for joining me today.
My pleasure. My pleasure as always.
So, Gary, last week, obviously, we saw the Fed announcement did a bit of damage to gold. Now, what did you make of gold moves last week?
Well, we absolutely got some corrective action. And to me, the question that I have been looking at was not if the market would correct, if we would get some sort of a release, but when and at what point. Considering that the market has moved from 1181 to over 1381, I think 1390.91 was the intraday high. We've seen a $200 move. And when you see that kind of move, corrections or rounds of profit taking are not only to be expected, but I believe that they're very healthy for the market because kind of like in a pressure cooker, it releases the steam. And so it allows more of an orderly progression to the upside.
Now, Gary, during gold's bull run, we saw silver percentage gains really shoot up. And now that we're seeing gold kind of going back up a bit, we're not seeing silver follow quite the way it did. Now, some analysts are attributing that because they're giving it the industrial component. Now, what do you think, Gary? Are gold and silver going for a divorce here?
Well, I don't think brothers and sisters or brothers and brothers can get married. It's always silver's always been considered, at least in my eyes, to be the little brother, the white precious metal that could, so to speak. It has been moving in a different manner than gold. We really noticed it at the beginning of the year because gold began to rally off of the bottom where silver maintained a really defined trading range. I believe it was about $1 to $1.50, maybe 19 to the high 20, $20.50, right in that range, and it couldn't break out. Then it really spiked to the top of the range and then really popped back down. So my sense is that the analysts out there, including myself, that are saying it's not reacting in the same way as gold are correct. What it will do next is anybody's guess.
Now, we have GDP numbers coming out this week. Now, I know technicians don't really give it too much of a thought. Are you going to be watching these numbers? And also, how do you see gold set up for next week?
Absolutely. Although, as a technician, we focus on different aspects, it is, without a question of a doubt, fundamentals that rule and move the market. See, to me, technical analysis is simply distilling fundamental information through the language of mathematics, which is easier for me to understand than the language of Bernanke or the language of economists. And so what drew me to technical analysis was really it was a way to identify raw data and put it in a way that I could understand it and make some kind of forecast from it. So the short answer is absolutely. I think that most technicians are going to be watching that number because that's going to change, or has the potential, I should say, to influence the market in a great way.
Excellent, Gary. Let's take a look at your inserts.
On today's insert, I wanted to pick up from where we left off on our last show, talking about a major cycle that I believe could definitely be in play and just beginning, and kind of clarify that in terms of Elliott wave count and what we talk about when we're talking about a major count, an intermediate, a minor count. And this is recorded on Sunday. Market's trading roughly at 1327. And when you consider that it's had an intraday high of just shy of 1400, I believe it was 1390, we've seen the market really come down from its recent high. But the recent high is coming on the back, of course, of a $200 rally. So here is what we are referring to. As you can see, in the upper left-hand corner, I have a basic illustration of what is called the majors. And this is would represent a major 1, and this would represent a major 2. And it would go 1, 2, 3, 4, 5. In the same way that you get a standard Elliott wave count, such as this, 1, 2, 3, 4, and 5. That would be a minor, and that would complete an intermediate 1. You would then go into your corrective phase, and that would be composed of some sort of an A, a B, and a C. As long as the market was still in a bullish tendency and perception, you would then repeat that. 1, 2, 3, 4, and 5. A, B, C. And then, of course, the fifth wave, or 5 out of 5, 1, 2, 3, 4, and then your 5 out of 5 would give you the top or the conclusion of a major wave. And so when I'm referring to a major count, I'm referring to these counts here. Major 1, major 2 represents this particular move here and here. Then I believe we went into a major 3 and then a major 4th. And so that would repeat this cycle again, meaning that we would be at the final stages of a major count, meaning a 5th out of 5. Now, when we look at the activity of today, of course, it's a little bit disconcerting when you look at it without looking at it in perspective of the big picture, because there's no doubt we are under pressure. And more importantly, when we look at the channel line, these cascading channel lines that we created from our Andrews pitchfork, we talked about the fact last week that for the first time we actually had exceeded and moved out of this channel. Now, that was to be short-lived, of course, because as you can see, dramatically the markets moved back into this channel. However, what we want to realize is that we're simply witnessing a corrective wave that corresponds to this most recent impulse wave, which was simply the $200 move that we just witnessed. So with that in mind, when we pull up a daily chart, and I'm going to go ahead and do that here. This is the long fall from grace. This is our most recent rally, and let's go ahead and blow that up just a little bit. When we do that, we've entered a couple of different fib levels of which we think this market could logically go to. Now, I had thought originally that we might be witnessing some sort of support at around 1332, but with the market down around 26, it seems a lot less likely. And so what I'm looking at is 1313, 1314. That would be, in my best estimate, a decent size retracement of this most recent rally, because what I've done is I've created two fib retracements, one which begins from the beginning of the rally, roughly just above 1180, and the second retracement, the fib retracement, starts at roughly 1237. And when we do that, I look for harmonics. Simply put, it's points in which both of these retracements are going to give me a similar price point, but of course it'd be a different retracement level. 38% for the longer retracement, 50% for the shorter of these two series. So it wouldn't seem that unlikely for the market to run $200, correct, and then begin to move back up. So for those of you that want more information on this topic, simply go to our site, goldforecast.com. If you're not a member, click Chart This after the show. It will take you to a link where you can go ahead and create your free account. If you already have the free membership, simply log in, sign on, and then click After the Show. That's going to take you to the most recent videos that we have done and the current bonus content for today. Again, Elliott Wave, Fibonacci retracement, and how that lends technical credibility to the fact that we could be entering a prolonged 2 to 3 year cycle in gold that's going to take the price of gold substantially higher from this point.
Gary, thank you very much for joining me today.
Hey, have a great week. Traders, investors out there, let's make the most of it, and we'll speak to you real soon. Bye-bye.
And thank you for watching this edition of Chart This. If you have any comments or questions, please don't hesitate to send them to newsfeedback@kitco.com, or you can ask me on Twitter @Alex_Letourneau. Have a good one.